When you read the internet discussions online about life insurance, things like term insurance versus permanent insurance, you think we're talking about like good versus evil or Jesus and Lucifer. Half the internet says that term insurance is the only righteous path, and then the other half says that permanent insurance, that's the key to eternal financial salvation. But life insurance isn't a religion, it's just math. That said, if Jesus were walking around today and he were buying life insurance, he'd probably flip some tables on the IUL salesman. He'd probably weep with the widows whose husbands didn't have enough. But he'd also look at someone who's sitting on maybe $500,000 in a CD or money market fund and go, "Are you serious? Go earn more interest." And for that job, permanent life insurance is really good. I think my industry does a terrible job of explaining what life insurance can do for a family like yours. And the non-licensed, self-proclaimed financial gurus out there, they do an even worse job. So stick around and you're going to see why some of my clients have $5 million of life insurance for less than $100 a month, how my son will have about $100,000 in cash by the age of 20, and account that over the long run, the returns are similar to earning 8 to 12% in a taxable account. And that's the kind of return people hope to get in the stock market with risk. And also how my dad could have turned a $100 a month policy into a $2 million permanent policy. And much more. Enjoy. If you're new here, I'm Luke, and I've been a financial advisor the last 5 years. And more importantly, I've spent those years sitting across the table with hundreds of families just like yours, walking through their policies and seeing how things play out over time. Not just new policies, but ones that were bought 20, 30, 50, even 70 years ago. And for scale, if you added up all of those policies together, it would be over $1 billion just in permanent insurance alone, not even counting the term insurance contracts. So I've definitely seen what works, what doesn't, and how people feel about those decisions decades later. And after seeing that many policies up close, I have a very different perspective than what you're ever going to hear online. Now let's start with how I simplify things. In life insurance, you really just have two choices: a temporary policy or a permanent policy. Temporary policies, that's term insurance. Term insurance is like renting. You pay a premium, you have the coverage, and as soon as you're done paying, it's gone. Permanent insurance works differently. It's kind of more like owning a home. It has two components: a permanent death benefit and also a cash value. In the cash value, you can think of it just like the equity inside of your home. It's going to grow over time, and you can also borrow from it. In some policies, when you're done paying for it, you still keep it, just like paying off a mortgage. The problem is there's a lot of different kinds of permanent policies, and some of them don't quite feel permanent. Nonetheless, the core idea of all permanent insurance is very simple. You pay a premium, fees are taken out, whatever is left over earns interest, that becomes your cash value, and you have a permanent death benefit. That's it. Now, if life insurance could be considered evil, this is usually what people are talking about. Universal life, IULs, non-participating whole life, egregiously sold annuities with like insane surrender charges. Because I'm in the know, I've seen thousands of policies, I've sold hundreds. It's super obvious to me that most of the people arguing about life insurance online have never actually seen a proposal. And where I concede things do get tricky, illustrations get abused, and marketing teams out there get extremely carried away. You might have seen a TikTok claiming $500 a month for 20 years, and you can get $100,000 a year of guaranteed tax-free income forever. That sounds awesome if it were true. If $500 a month could safely produce $100,000 a year of guaranteed income, Wall Street would shut down tomorrow. And unfortunately, there's a whole corner of the internet and an army of life insurance agents that are showing these types of policies at extremely optimistic assumptions and presenting them like guarantees. That's not how real financial planning works. And for one reason or another, Congress doesn't care. Most legislation concerning life insurance sales is just state regulated. And as it stands, what I'd consider to be insanely abusive sales practices is totally normal. Like happening all over the place. Even one of my closest friends, he was paying $1,500 a month, $18,000 a year, into an IUL. And when we reviewed it together, on paper, It looked awesome. But when we walked through the actual mechanics of the policy and where these numbers were coming from, the numbers did not hold up to the scrutiny. And the worst part wasn't even the money he's already paid into it. It was that feeling of embarrassment because he bought the policy from someone he thought he could trust, and he felt like he just should have known better when it looked too good to be true. And that story isn't rare. Some permanent policies, like universal life, like index universal life, they're not built on guarantees. That's why you'll see horror stories of someone who they bought a policy for $200 a month, and then years later, they have to pay $2,000 a month, or every single dollar they've paid into it is gone. Or you see on the news just days ago, a famous NASCAR driver just settled an $8.5 million lawsuit over the IUL he was sold. Imagine being told if you pay $10 million into something, that by a certain age, you'll get $800,000 a year of guaranteed income for the rest of your life, and tax-free. But there you are, 7 years later, you review your policy, and your $10 million you paid, you only have $1.5 million of cash inside the policy. You don't need to be good at math to know $1.5 million cannot produce 55% returns for the rest of your life. So it just doesn't matter how old you are, how much money you've made, or how much success you've experienced. This can happen to anyone. And what's really insane to me is that of all the permanent insurance policies sold today, 30% are IULs just like that. And I promise you, most of the people buying these policies, they do not know that by design, on purpose, the fees go up in that policy every single year. That shouldn't be a shock. That's the way they're supposed to work. But it always is, because the people buying them weren't told that. So for that reason and many others, I'm very cautious when it comes to universal life policies, given the non-guaranteed elements. What I like is a permanent policy built on guarantees, something that's simple for me to understand, and I know how it's going to play out. For example, whole life policies work way differently. Your premiums are guaranteed, you know exactly what you're paying and for how long, your death benefit is guaranteed, and you can pay for it for 10 years, stop, no more fees. You keep it, it keeps growing, it's truly permanent. So to me, if your high yield savings account and your Roth fell in love and they had a baby, that would be whole life insurance. Whole life insurance gives you the best of those worlds, giving you a space to store safe money. Get good returns, 100% tax-deferred growth, take money out tax-free through loans, and also get a death benefit tax-free. So no tax, no tax, no tax. The extreme downside is that in most cases, if you own whole life insurance for just 2 years, it looks terrible. I mean awful. There is no too good to be true in whole life insurance policies. The reason it can work so awesome in the long run is because the fees are front-loaded, just like buying a house. You almost never hear of someone who bought a home, sold it 2 years later, and they didn't add anything to it, and they came out ahead with a profit. There are just too many upfront transaction costs, not to mention all the stress of buying and selling real estate. But despite that stress, we all know there is wisdom in buying a home long term. And this is what confuses me the most about this topic online of term insurance versus permanent insurance. People are smart enough to understand the long-term benefit of owning a home despite the upfront costs, but they don't see the same benefit in owning their life insurance, even though it's the exact same value proposition. They tell you you should only rent your life insurance. Rent, 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 term, 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 nothing else. Never own your life insurance. And I will concede, renting, it feels great at 35, but it feels terrible at 55. And the same reason it's smart to own your home is smart to own your life insurance. But no one tells you that. When's the last time someone told you, oh, you just got married, you bought a house, congratulations. Oh, you own life insurance? Term insurance, you're renting? Why are you renting? Don't keep renting forever. You're just throwing your money away. And you'll hear that all day long with real estate, but never with life insurance. Quick sidebar before we go further. Every parent should own a fat, juicy Wagyu beef style term life insurance policy. I'm talking like 600-pound life-size coverage, Costco-sized, not an appetizer, a full Thanksgiving dinner. Because if something happens to you, your family deserves to not have money stress. You know, when I married my wife, I went pretty old school with it. You know, in my vows, I promised to love her, to honor her, to forsake all other women. but I also promise to provide for her, for better or worse, in sickness and health, even if I'm dead, because I love her. And I remember when we were dating as teenagers, I asked her, hey, what's your greatest fear in life? And what she told me actually surprised me. 2 words: being broke. And what's interesting is that if you ask that question of her today, that fear is only multiplied of me being gone, I'm dead, and now she's a single mom with kids and broke. Guys, we have a chance to solve this fear for our wives. Term insurance is dirt cheap. I get it. Some of your wives, they're fantastic human beings. If you brought up life insurance to them, this is what they'll say. Well, honey, if you died, I'd manage. I'd move in with family. Maybe church would help out, or I get a job, or I get remarried. But reality is never that clean. But thankfully, term insurance is super cheap. I bought a $1 million policy when I was young in my 20s, just $20 a month. Now that I'm older, I've got kids, married, I actually upgraded my policy to $5 million. I pay less than $100 a month for it. But in about 10 years, it's gone. It's temporary, but I've got a game plan for that. So don't misunderstand this video. I know I'm talking a lot about permanent life insurance, but permanent life insurance is a luxury, just like owning a home is a luxury. Term insurance is a necessity. So all right, term insurance is awesome. But here's where people get it wrong. They hear that and then throw out permanent insurance entirely. And I don't think that's right. So instead of arguing about it, let me just show you. The simplest way I know to explain why I like permanent life insurance is with 3 people: a baby, a teenager, and an adult. We're going to compare $100 a month to the same life insurance policy, the same company, same design, same funding. The only difference is just the age at which the policy starts. Let's compare them, and you can decide if there's any merit to it. Now let's start with the baby. $100 a month from birth. Nothing crazy happens at first. It actually looks pretty boring, kind of flat. But just watch what time does. At 15, maybe that's enough for their first car. And at 35, maybe that's enough to get them into a better house. And year after year, decade after decade, by the time they're 50, 60, this isn't a small policy anymore. This is real money with a lifelong safety net attached to it. And let me make this real for a second. If my grandpa had done this for my dad, $100 a month, by the time my dad's in his 50s, almost 60, that little policy is on track to grow from 1 million to 2 million. Meanwhile, if my dad went to go buy $2 million of life insurance today, he's looking at $25,000 a year just for a term insurance plan, a temporary plan, or $90,000 a year for a permanent plan. So my dad, he can get the same program today. It just won't have any cash value to start and be about 100 times more expensive. Food for thought. Now the teenager. Same $100 a month, but we're starting 15 years later. So these years right here, you don't get those back. So yeah, it still works. It's just not the same. But let's do a comparison real quick. Let's compare the cash growth of this versus our life insurance zealous baby. Now look at 15 with me. $18,000 cash for the baby, and the teenager, well, they're at 0. They just started. Now jump to age 35. The baby's around 90 to 100,000 cash. Teenagers close to 25,000. And then by retirement years, the baby's pushing $600,000 in cash, and the teenager, not even half that. And if they both reach 90 years old, the baby's beneficiaries, well, they're splitting $2 million. The teenager's heirs split $800,000. And if we slow down and we crunch the numbers, how much more did the baby pay than the teenager? $18,000. That's it. The baby paid $18,000 more, but creates more than double the value, potentially $1 million more over their lifetime? Yep. That realization, the first time I saw this, it was eye-opening. Now, what if your kids are already teenagers? Let me tell you about a client. A few years ago, I worked with a family with 3 boys, 1 in college and 2 still in high school, all of them phenomenal athletes. Now, we talked about permanent life insurance, but at the time of when I met them, their main focus was just college expenses and trying to pay less money in taxes every year. A year later, I get a phone call. Their 17-year-old son collapsed on the baseball field and he had no pulse. And later on, he gets diagnosed with a serious heart condition. And looking back at my notes, here's what I wrote from our last meeting. Permanent life insurance for him? Too expensive. For the kids, he liked it, but only after college. Asked me again in 5 years. That was hard to read. Hindsight is always 20/20, and obviously, if he knew that his son was going to have a heart attack in a year, he would have bought as much life insurance as he could have. We all would, but he didn't know that. When I showed him this idea, he didn't care about the death benefit. He was just looking at the cash value. And he said, oh, that sounds cool, but just not a priority right now. Let me pay for college first. But what I've learned is whether it's a 17-year-old or a 45-year-old father, life doesn't wait. The risks change, but they're always there. That's why permanent life insurance matters long before you even think it will. So, should you be buying this on your teenagers? I don't know. It's something to consider. But let's continue and look at the adult this time. Same $100 a month, but the shortest runway. They didn't just miss 15 years like the teenager, but 35 years. And yeah, the numbers are smaller. And if we only look at the cash value, it's not super exciting. But I want to say something here. I've sat with widows whose husbands just passed away, maybe only 2 years into retirement. And when that check shows up, even 100,000, 200,000, 300,000, it doesn't fix everything, but it helps. Even in families worth millions, there's something about life insurance, it just takes the edge off. It gives your family a win, even during a dark season. And that matters. And let me level with you. I think this is the part that people feel, but don't say out loud. We all kind of wish that tragedy, it just would skip our family. But the truth is, tragedy doesn't skip people. It's just a matter of when. And when it comes, having a plan in place really can make a difference. Even a relatively small policy, $100 a month, that you start at 35, that became $100,000 or $200,000 in retirement, that can make a real difference. So what's actually going on here? Let's take a step back and slow down for a second. When we compare these three, the baby, the teenager, and the adult, it's pretty simple that time does most of the work. The earlier you start, the more compounding has time to do its work. And from a cash perspective, I tell new parents this all the time. If you're deciding between $100 on you or on one of your kids, just looking at the end game, it's like adding a zero. At 90, you might have around 200,000, but your kid, maybe around 2 million. And they didn't hardly do anything extra. They just started earlier. And in compounding, when you start matters more than how much you do sometimes. Now, some parents, they see this and they go, it sounds interesting, but it's just not a priority right now. And that's totally fair. But I've also sat with parents who, even as young as 30 years old, who can't get life insurance anymore. Maybe they have an autoimmune disease, diabetes, high blood pressure, medications, maybe they smoke. And now, even just $1 million of coverage for a short term, like 10 years, costs $1,000 a month. Or worse, they can't get anything at all. So for those parents, buying life insurance on their kids, it isn't about the returns. It's about locking something in while they're young and healthy, because they know that the only time that some people can buy life insurance is during childhood. Now, here's the part that most people are never shown. The real epiphany moment that I had. Let's revisit the baby's boring policy, and it doesn't have to stay boring. Stay tiny for 50 years and only get massive at retirement. Let's tweak one thing, and instead of $100, let's make it $125. Just $25 extra, not necessarily to grow the policy, but to create flexibility. That $25, it's going to change how much you can put in and when. For example, fast forward and say your child is 25 years old and they've got some savings, maybe $30,000 sitting in an emergency fund, and they're starting to think about maybe a house down payment, their next step in life. So instead of just letting that money sit, they reposition it and they move it into their life insurance policy. $15,000 one year, $15,000 the next, and then $15,000 a third and final time. Then they go right back to the $100 a month program. Now, look what happens when they do that. That increase, this is what happens when you give your policy that little bit of wiggle room and you take advantage of it. It lets you double what you have inside. Now, at any point in your policy, you can access your cash value. So you could pull out $100,000 for the house or anything right now. But let's assume they leave it alone, not just to see what it turns into over time, but to highlight a common crisis I see people get into. Because the mistake that most people make is when they build up their $100,000 to buy a house, they end up using every single dollar to buy that house and then go right back to zero again. They could have spent 5 years saving up, feeling free as a bird with a big cushion. But when people buy their first home, it's very tempting to use every penny. That's stress. The goal shouldn't just to be buy a house, but to close escrow without feeling broke the next day. So to me, one way to honor that small decision like a parent made to buy this policy for you, buy your first house, but also have that $100,000 left over. That's peace. And if you're married, a happy marriage. So if you could pull this off, it's going to double your safe money over your career. Here's what I mean. Instead of that $100 a month creating $90,000 at age 35, imagine it creates $170,000 and about $300,000 more to your retirement program. Almost $1 million instead of $600,000. So just by moving over that emergency fund into the policy, it pushes your death benefit to $3.6 million at mortality age. That's an extra $1 million just because of where you wanted your emergency fund to live. So $100 a month, $125 a month, you're not going to feel that. But one day, your kids will. And this is the part that even other advisors I work with always miss. It's not about what that $100 a month creates on its own. The real power play for parents, it's giving their child an account they'll keep forever. Tax-free growth, safe and predictable. An account that, over the long run, the returns are similar to earning 8 to 12% in a taxable account. And that's the kind of return people hope to get in the stock market, with risk. But this is happening with your safe money, no risk. When I take risk or my clients take risk, we want to be rewarded for it. We want multi-double-digit returns. If all we're after is just 7 to 8% on average, we can do that with our safe money. I'll take my 7 to 8% with no risk and no stress. Thank you very much. And that was the epiphany I had that made me obsessed with safe money. I just started connecting the dots. When your safe money is rock solid, you can afford to take more risks with your investments. If you like playing poker, you know that a bigger stack lets you play bigger hands. That's what strong, safe money does for a financial plan. So yeah, I'm the safe money dad, but I'm not anti-stocks. I'm not anti-risk. I love poker. I just like my safety net first. And it turns out your safety net, it can grow surprisingly large. So when I meet people sitting on a large amount of cash earning just like 2% after tax in a bank account, I don't tell them it's a sin to keep hundreds of thousands or even millions in cash and to go chase high-risk investments. What is a sin is letting that cash sit there, barely growing, when it could be compounding safely for generations. Now, I'm using $100 a month because it's just easy math. But just so you know, the people who really get the most out of something like this, they already have the basics handled. They're saving consistently, they've got a solid emergency fund, and over time, their income's probably grown to a point where they're sitting on more cash than they know what to do with. For those people, shifting that idle cash can turn a 3 to 6 month safety net into a 3 to 6 year safety net. And even putting, 1 to 3% towards policies on your kids, life-changing. That's where it really starts to compound across generations. And that's why when my son turned 2 weeks old, I applied for life insurance on him. And I was just grinning ear to ear. And when I showed it to grandma and grandpa, you know what they said? How much can we put in? 529s are great, investment accounts are great, but you already know about those. This is the thing you probably haven't heard about as a parent. And I sometimes think about this. If my grandpa had done this for my dad when he was 5 years old, my dad was born, like 1960 something. Today, if my dad passed away, my siblings and I might split $2 million. And I'm a new dad. I've got a toddler at home, just bought my first house, trying to grow my business. Imagine $400,000 landing in your lap tax-free during that stage in life. That changes things. And if I know I wish my grandpa did this for my dad and that my dad did this on me, maybe I should do this on my kids. And this really isn't about the amount. It's just about the structure and the timing. Now, I'm not saying life insurance on your kids should be a top priority, but it's an option and you should know your options. And maybe You could be the first person to knock down that domino in your family. Why not be the one to start it? Now, let me address the skeptics in the room, because I made this video for you guys, for the permanent life insurance skeptic. If you've been told that permanent life insurance is crap, or it's a ripoff, or that if Jesus were alive today, he would just buy term insurance and pay off his house early, here's the question to ask yourself or anyone who's advising you. Where do you keep your safe money? Because that's the part most people skip. And to me, this is the root of the problem. The entire world of personal finance advice online is just obsessed with investments. It's turning into bro finance or get rich quick or chasing the next thing. One year it's Bitcoin and Tesla, then it's Nvidia and XRP. It's always going to be something. But I think most of us, we're just trying to keep up and make sense of everything. And of course, meanwhile, back at the ranch, their safe money, it's sitting in a high yield savings account earning 2% after tax. That does not sound high yield to me. So for me and my household, I want to make safe money sexy again. Because your safe money doesn't need to just sit there. It should grow, it should protect your family, and it should be something you actually feel good about. You see, life insurance, it's boring, simple, well understood, and in my view, it's the best place for safe money to live. Predictable, lifelong, extremely underrated. I mean, imagine if GoFundMe's didn't exist because everyone started a permanent life insurance policy from day one. So that's what I think about permanent life insurance. I like it, especially for kids. It's pretty interesting. And the policies I bought on myself and my wife before having my son, the cash value, it's growing every year more than what we pay into it. And we have a permanent death benefit. I mean, what's not to like? That said, I'd probably disagree with about 70% of the insurance policies sold today in America. So yeah, it turns out there's a lot I don't like. But when it's done right, it is incredibly powerful. And if you're thinking, okay, well, I should probably look into this, please do not Google life insurance agent near me. That's usually how people end up buying a policy that looks good on paper, but it's garbage. And I mean it, like garbage. Don't buy life insurance from your car insurance lady. I don't care what the bundle deal is. Don't do it. Don't buy life insurance in a work seminar. Don't do that. I've seen those policies. You don't want them. Make sure you do this right and take your time. You know, these policies can be simple, but the way they're set up matters a lot. Work with someone who understands when they're good, when they're not, and can guide you through your numbers and goals. And if you want help with that, I'm here for you. Use my link to get in touch. And final thing, if you enjoyed this video, do the unthinkable. Tell me so in the comments. You know, like, what questions did you have watching this? Was there anything you want to learn more about? Am I the only one who's getting bombarded by IUL TikTok advertisements? Or do you get those too? You know, I love to hear from you, and by liking and commenting on the video, maybe more families will see this. And together we can tell more people how to build financial strength the right way, one family at a time, one generation at a time, because we can. I'll see you in the next video.